So the employee benefits is extra compensation provided by the employers that is usually not cash related. There are some benefits as far as bonus structures that are related to getting actual extra money, but it is considered compensation, which is sort of like extra pay. And there's various different kinds of benefits that you can get. Insurances includes or may include medical, dental, vision, life, or disability, and disability comes in short-term or long-term. Now, your employer may provide one or a couple or all of these or none of them. Of course, medical insurance, we're all familiar with that. Dental covers non-cosmetic dentistry, so it won't cover, you know, like veneers or bleaching or whatever, but it'll cover fillings and root canals and all that stuff. Vision typically will cover like either like one exam every year, and then some of them will give you a pair of glasses every single year, and some of them will only give you glasses every other year, or you can have a choice of glasses or contacts, but not both, kind of thing. Some of them will do both. You have life insurance. Employer provided life insurance is term life, not whole life, which means that if you were to quit that job and you didn't take over the monthly payments yourself, then the insurance goes away. And then there's disability insurance, short or long-term disability. This covers you in case you're injured and can't work. It provides usually right around 2/3 of your pay, most of them. And then they can either be fully or partially paid by the employer. For example, our medical insurance for us, our employee medical insurance is fully paid. If you have a family plan, I have to pay for my family, but they pay for me fully, that kind of thing. Or maybe they'll pay 80% and you pay 20%, or just depends on the employer. Then you have paid vacation time, which is paid days off, and that's usually earned after a set length of time. So maybe like after you've been there a year, you get 2 weeks vacation, something like that. And that varies with employers. Not every employer provides vacation time. And then some employers pay for holidays off, but you only get paid for the holiday if you were actually scheduled to work on the holiday. So if the holiday falls on Sunday and that's not a day you guys are open, they're not going to pay you for it. But if it's like a Tuesday and you're normally working on Tuesday, they'll pay for the holiday. That makes sense. Retirement plans. Usually it's a combination of employer and employee contribute to them. And again, some places they do matching. So if you say, well, I'm going to put $200 a paycheck into my retirement plan, then they'll also put $200 a paycheck into your retirement plan. Some of them it's not matching. There's percentages. It just depends on the employer. And there's different kinds. There's IRA, which is independent retirement account. There's 401ks. There are pensions. There's a whole slew of retirement plan options available. The most common employer ones are the 401k and the pension that are employer contributed, but that doesn't mean that's the only ones. Pensions are rare and awesome. Okay. A pension, unlike if you have a 401k account, however much money is in that account, like the balance of the account, is how much you have to live off of for the rest of your life after you retire. So you have to figure out how much money should be in there. A pension, you do contribute to a pension fund and your employer contributes to a pension fund, but with a pension, it's based on your salary at the time you retire and the number of years you worked for the company and a percent. They take your average salary, the number of years, and a percent, and they multiply them all together. And that is your new annual salary from the day you retire till the day you die. So it's a set amount of money every year, like they give you a monthly paycheck still. until you die. So pensions are really good because if you have a normal retirement account, there's a chance you could run out of funds if you didn't have enough in there. But if the pension, you know, I am going to have this much money every month to live off of until I die. Very fun. Some employers provide stock options as benefit, and this can be tied to a retirement account, or it can be like performance-based, something like that. And what this happens is they give you shares of stock. A lot of employers will do stock matching. If you do retirement accounts, like a 401k based retirement account is a stock based retirement account. And if you do, you can choose any stock. They're not allowed to tell you what stock you can choose, but a lot of them will say, well, if you buy our stock, we'll match. So like for every share of stock from us you buy, we'll give you one more share of stock. Things like that. So it just depends, again, on the employer, how it's all set up. Child care leave is paid time off to care for a newborn or a sick child. Also, maternity, known as maternity leave for, like, you know, newborn. But some employers offer paid time off, like paid maternity leave or paid child care leave, which could be paternity leave, so like a new father could take time off. Or they will pay while you take care of a sick child. So if your child became ill or hospitalized and you needed to take the time off, they'll give you that paid leave. Now, there is a law called the Family Medical Leave Act. The employer does not have to pay you for time off for child care leave. However, they are required by law to allow you to take child care leave. They cannot fire you because you need to take time off to care for a family member. You do have to fill out certain paperwork to get the Family Medical Leave Act time off, but they cannot fire you because you had to take time off to care for a family member. And that can include your kid, your significant other, your parent, immediate family. But as again, some places do provide paid time off, and that would be a benefit of child care leave. Some companies will only provide insurance to the employee and pay for that, and some will also pay for part of the family to be covered. So you could have your kids covered, or your spouse, or your whole family, and they'll pay for part of that. Again, and then some just pay for the individual employee's insurance. Depends on the employer. They're not required to provide any insurance. Pension, we talked about this. This is the retirement plan in which the retiree receives a set amount of money from the date they retire until they die, based on calculations of average income over a certain set period of time, times a percentage, times the number of years that you worked for the company. So the longer you work for the company, the higher your pension. Unemployment insurance is employer paid. You do not have to contribute to this. And it covers an employee to receive some income in case of a loss of employment due through no fault of their own. That means you cannot get fired from your job because you did something wrong and then collect unemployment. You have to be laid off. The company goes out of business, they're downsizing, they're relocating to another area and you can't relocate, so you lose your job. If there is a legal issue, the employer is not paying you, so you quit because you're not getting paid, then you're covered. But if you just quit your job because you don't like it, you don't get unemployment insurance. So there's different various scenarios where you're covered versus where you're not. But it can't be your own fault. If it's your own fault, then you're not covered, pretty much is the way that works. Yeah. All right, base period. This is the length of time that your unemployment benefits are based on. And different states do different things. It can be a year, it can be 6 months, it can be a month. It doesn't, it's up to the individual state. Unemployment is federally mandated but state run. So the states determine the length of time. And so what they do is they take your average pay during whatever that length of time is. They multiply it by a set percentage, and then that's up to a state maximum and per week. So each state has their own set maximum also. Then you have workers' comp, which is employer-paid coverage for injuries on the job, which is also federally mandated for certain sized companies. A business owned by an individual with less than a set number of employees, which I don't remember what that number is off the top of my head right now, but I think it's like 5, is not required to carry workman's comp. Now that's not a corporation. If they've set up a corporation, that's different. If they're a sole proprietorship, so they're an individual-owned business, small business, they may not be required to carry workman's comp.
Does their insurance go up if they do syndrome?
No. Okay, so let's do some example problems. Alan works for a printing company, and it has been a little over 4 years since he was hired, and he makes $54,080 a year. And he gets 5 paid vacation days. 5 paid vacation days. And then each year he gets 2 more days up to a maximum of 20 days. So how many paid vacation days does he get now at the end of 4 years? And how much money does he make during the time he's on vacation? So this is a 2-step process. So we start with the number of vacation days. And then we figure out his pay while on vacation. So he started out with 5 days. And then he gets 2 more days each year. And he's been there for 4 years. So that's 5 plus 8. So he has 13 vacation days. So far okay? All right. Then his pay while he's on vacation. First we have to figure out how much does he earn per day. Okay. So he makes $54,080 a year. We're going to assume it's a normal year and divide by 365 because that would be his average. Like a leap year is not going to make that much difference. So unless you're specifically told on a leap year, always just do 365. So he makes $148.16 per day. And if he takes all 13 days of vacation, while he is on vacation, he is earning $1,926.08. Okay, next question. Frida's employer is paying family health care. She has to give 12% of the cost, so she's providing 12%. And the employer covers the rest. And she gets paid on a bi-weekly basis. And she gets $88.50 taken out of each paycheck. Okay, so we want to figure out how much does her employer pay. So Frida is 12%. So her employer pays 88%. Make sense so far? She gets paid, takes $88.50 out of her check. So 12% of the total is equal to $88.50. So if we divide that by 12%, we get $737.50 every 2 weeks. Now it doesn't say how much does Frida's employer contribute for her coverage annually. It just says how much does it contribute for her coverage. So we're going to assume that's per paycheck. If it said annually, then we'd know that we need to make it for all of the whole year. Okay. The total is $737.50. The employer contributes 88% of that. So we take that $737.50 and we multiply it by 0.88. So they're paying $649 every 2 weeks for her insurance. Marina is retiring and she gets a pension. Okay, so we're going to work out the pension calculation here. 1.5% of her average salary for 5 years times the number of years that she's working. So what you do is you take, to calculate a pension, it equals the average salary times the percent times the number of years. Okay, so we have the percent and we have the number of years. We need to figure out the average salary. So first we find the average salary. And it's a 5-year average, so we take the 5 incomes and we divide it by 5. So our average salary for the 5 years was $95,420. Then we find the pension second, and we take the 95420 times 0.015 for the percent times 25 years. So she's going to earn $35,782.50 every year from now until she dies. So that's about a third, roughly. Okay, in Reese's state, the weekly unemployment compensation is 60% of a 26-week average. Okay, so this is the base period that we talked about right there. For the 2 highest salaried quarters, a quarter is 13 weeks. So it's 3 months. So for July, August, and September, he earned a total of $9,024. And in October, November, and December, $9,800. But we want a 26-week average. So we take these 2 periods and we divide by 26. For the average. So I have to take 9,024 and I add that to 9,800 and I get 18,824, which I then divide by 26. And that's an average of $724 per week. And then they pay 60% of that, which means I have to take 724 times 0.6. So on unemployment, Reese will earn $434.40. Wanda lives in the same state as Reese, so same rules. Her weekly unemployment is $360. So we want to figure out what were her 26 weeks earnings, like what was her total. So we're going to go backwards. So what we had done before is we took the total and we divided it by 26 to get the average, which we multiplied by 60% to get the unemployment. Okay, so now we need to go backwards, so we're going to go this way to get to the total. So the first thing we need to do before we multiplied by 0.6, so we have to divide by 0.6. Okay. Which would be 600. And then we divided by 26, so now we're going to multiply by 26. So her total would have been 15,600. That's the non-algebraic way to do it. If you wanted to do it algebraically, we would say t over 26 times 0.6 equals 360. And we'd multiply 0.6t divided by 26, so that would give us 0.023076 blah 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 t is equal to 360, and we divide both sides by that decimal. And we'd get the same number. So you can either do algebra or you can work backwards. Whichever makes. Okay, on this example, we're going to figure out basically the same thing that we just did for Wanda, but we're going to figure out the weekly salary. She made the same weekly salary each week, so her weekly salary will be the total divided by 26. Does that make sense? Because it was the same every week. So we're going to go backwards again, 570 divided by 0.6, because that's how much her unemployment is. But now, do I need to multiply by 26 to find the total and then divide by 26 again to find her weekly salary, or can I just stop here? Here, see how we had done this process? If I continue on that process, I'll multiply by 26, which will give me that she made 24,700 total. But she made the same amount every week, so I'll divide by 26, which means that she'll make 950 per week. But this part right here was completely unnecessary because I already have her average. Her average salary weekly is equal to her actual, because she made the same amount every week. So this right here is the average weekly salary. But if you make the same amount of money every single week, your average weekly salary and your actual weekly salary are the same thing. Does that make sense? Kinda? Because if I take 950 and I multiply it or add it up 26 times and then I divide it by 26, I still just get 950. So the average and the actual will be the same. Any questions on that? That's not to say, like, if you don't remember that, you can do all the same steps and you get the same answer. So you're okay either way. Okay, and we're going to stop there because we don't have time to do